I'm Peter Lundgren, founding CEO at Lundgren's Capital.
And I'm Mel Lopez, Chief Economist for ASEAN.
Welcome to Sound Economies with Mel and Peter, an East meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi Mel, how are you doing today and how are things in Manila?
Hi, Peter. It's actually been a rainy week. We haven't seen some sun since Monday, but otherwise, everything's looking up. How are you, Peter?
Yeah, here we really have the sunshine. We have I think the hottest day in 77 years yesterday. It's very unusual for this part
Right.
of Europe. We should have rain like you have, but anyway. So it's nice, and of course I also use the opportunity to congratulate you with your birthday today, Mel.
Thanks, Peter. That's so nice.
Good. I hope you will celebrate well tonight and coming weekend. But anyway,
Thanks.
we have business to do. So
Mhm.
what sort of interesting sort of the small piece of the big world have you picked out today?
Right. So actually, I was very interested and I wanted to discuss this bit that I saw about some European countries in particular are pushing back against what they're calling to be over tourism. So in this case, over tourism is like the locals are quite getting quite tired of seeing the flock of tourists around their homes, basically, which happen to be very close to popular tourist destinations. So, in
Uh,
Spain, for example, we've seen locals spritz water on tourists that they find annoying. In the Netherlands, they're actually have a campaign called Stay Away, which is targeted towards people they brand as rowdy tourists. But in general, it's just putting all tourists off. And in New Zealand, they're tripling their tourist tax, which is quite odd to see because typically you'd want tourists, right? Because you want their money, you want it's additional revenues for the government and for private businesses. In Japan, for example, there are areas where they're putting up boards to block the view of Mount Fuji, which is very peculiar considering you'd want that very beautiful view, but locals are quite annoyed. And there's this trade-off about between receiving the revenue boost from foreign travelers versus the effect of urban congestion, higher prices, especially for housing, since the rental market for tourists is quite could be quite lucrative. And of course, we know that tourism could be a driver of economic growth. And for these developed economies, you'd expect that they'd want the tourism boost because their growth is rather stagnant. But yeah, it seems that they can afford to be choosy, and tell these travelers, sashay away. We don't want you here. But yeah, so it's a time when we expect uh more tourists because of the revenge travel post pandemic, but it may happen to be the case that they're gonna go somewhere else instead, where maybe in developing economies where they're more welcome and they won't be spritzed water on, right?
yeah. It is, as you know, the summer season here in Europe is moving closer to what you would say the off season, not
Mhm.
necessarily the low season, but the pressure is now decreasing on all destinations, I believe. But it is a returning, how to say, debate, or even worse than that. And this year, I think it reached new classes, as you say, demonstrations and against
Mhm.
tourism in some certain very much wanted areas by tourists,
Mhm.
and it will return next year. There's no
Yeah.
doubt. It
Yeah.
is a problem,
Mhm.
particular if this sort of mass tourism also drives up the housing rent. People have difficulties finding, as a local people have difficulties finding a place to live, or it's too
Uh-huh.
expensive. So it is an issue. But you mentioned New Zealand, you mentioned Japan. How is that an issue across other countries in Asia, or is this just how to say Japan and then Oceania, New Zealand?
Yeah, I'm actually seeing it more of the developed world and mostly on the European side of the world. In Asia, we really very much like tourists still. Even the developed economies, say Singapore, for example, they've been very active in their promotions of tourist arrivals here, and it has shown that tourism can really invigorate economic activity. So pretty much you want them here, not elsewhere. And policies like this, or in Europe, for example, could simply bring people elsewhere. And people who think they'll be turned away in Spain or in Portugal, maybe they'll find themselves heading to Bali instead, or maybe in the Philippines, in Boracay, right? So it's not gonna kill tourism, but maybe see more flights somewhere else rather than in Spain or elsewhere in Europe, for example.
Yeah, yeah. Yeah, so, as we have at Longreach, we've had some internal conversations about what should we expect. Likelihood
Hmm.
that there will be some limitations on tourism in certain areas, but
Hmm.
our conclusion is it doesn't limit tourism globally seen because the demand is there. People
Right.
they actually would like to travel. So in case then they will travel somewhere else, and it's good to learn and to know that they're extremely welcome also in the Philippines. Uh,
Right.
and so as if we look into sort of saying the airline industry, they'll probably not suffer. There can be
Yeah.
some local areas where it could affect the housing prices because we argue there's a speculative effect in some areas, the
Hmm.
most wanted areas. There's simply a speculative effect that goes into the housing market. And they could see lower prices, though in other areas they might go up as people are buying condos, speculative to rent them out for short-term stays. Yeah. So
Right.
there we could see an effect. But globally, sort of the travel industry, yeah, they'll just move, and that is interesting. So there might be some also hotel chains that could profit from this,
Oh,
and other hotel chains that might, depending on where they are sort of exposed, yeah, that
right.
feel a lower sort of
Hmm.
turnover. But that this is what we see. But it's an interesting discussion because it's a returning discussion, and
Hmm.
it's been very intense this summer in Europe.
Right.
So,
Right.
so maybe you will have more more Europeans coming to. It can I can recommend to go there.
That'll be your tour guide. How about in your side of the world, Peter? What are you seeing? What's something interesting you can share?
Yeah, the sort of it's not a small topic, but it's on in our podcast. It's sort of the small pic, the small piece in the big picture, and what I sort of think is interesting to give some attention is the Volkswagen, the VW case in Germany. What's going on this week?
Hmm.
They are now decided to close down two production facilities, two production sites,
Hmm.
and that is how to say it, depending on how you see it, what is the reason? But
Hmm.
the reason is basically they have tried to do some cost cutting, and as the management say, it didn't materialize enough. So they're running with overcapacity in Germany, and
Hmm.
production costs are too high.
Right.
And that is what our as from the helicopter perspective, this is
Hmm.
another sort of wake up shock for the German society. That's the whole production and manufacturing industry is suffering. The growth GDP growth in Germany is around zero, and these huge companies are not competitive. That
Hmm.
is just one more sort of sign of the badly needed reform work that has not been undertaken for 25 to 30 years now. We've seen 2 weeks ago a sort of a very famous German shipyard. They are building among the biggest cruise ships in the world that needed to be bailed out by the German government. Sort of experts were arguing that it was just sort of a small bump on the road. Everything is working fine on the shipyard, and they're basically right. They just were missing like 2 to 3 billion euros.
Mm-hmm.
And that is, of course, the economic proof of nothing is right. And seeing more of these things. And the key is that there's no discussion about how to improve the situation. And that is very, very important for investors to
Right.
keep an eye on. Of course, it is. As we're talking about the largest economy in Europe and one of the largest economies in the world.
Mm-hmm.
And so to say, it just underlines our view. Again, we have since years talked about underweighting investments, particularly when we talk about equity allocation away from Europe. We've seen Southern Europe as close to uninvestable and been questioning Germany more and more about how attractive this destination is for investors.
Yeah.
And this is just another sort of just another sign. Yeah, uh, it's how it is. There's no change, and but this story is interesting to dive into to understand what is the real story behind. The Volkswagen management is saying that the market simply disappeared. There are 500,000 vehicles that are not sold anymore. It disappeared for Volkswagen, but other car producers, and we see the invasion of Chinese EV cars is sort of also the European market. And that is, of course, a big trouble and problem, but this is part of the story. So that is worth to follow and worth to dive into. That's a sort of one of the small pieces.
Yep.
Otherwise, Mel, we've decided to dedicate this podcast to what's going on uh, in sort of the global financial markets.
Yeah, so currencies in Asia have been appreciating against the US dollar in recent days, and many are seeing that it's mostly in reaction to a weaker dollar that's also reacting to weak US economic data. So of course we've discussed in past podcasts that the US Fed's September 17 to 18 meeting is the big event which everyone's waiting for, and given the anticipation that a rate cut is coming in 2 weeks time, so the dollar's weakening and currencies are appreciating against that, and also an indication that foreign investments are flowing slowly away from the US and towards emerging markets in Asia. Um, Meanwhile, stocks in Asian stocks are down, except of course the Shanghai Composite Index. It's an outlier among other performances because um there is some optimism there. Otherwise, all other stock markets are tracking the US tracking Wall Street. It's also going down. We've seen weak jobs report this week, and we're expecting the non-farm payrolls data on Friday, and the market expects that it will be weak as well. So it could trigger a more aggressive response from the Fed by mid-September. So that's really where the sentiment is. And currently, and as you pointed out before, there could be more weight to a 50 basis point rate cut by the US. And do you still think that's the case that we'll see in 2 weeks, Peter?
Yeah, I still go for the 50 basis point rate cut, man. And we will talk a bit more about in particular the U.S. stock market and sort of the global effects. But I would like to circle a bit back to the discussion about the Asian currencies,
Mhm.
um, because this is important. If we see any sort of general changes in the tide, in the trends, because if for investors, international investors who are investing into emerging market
Mhm.
debt, also if they're going to East Asian emerging market debt, then the currency part of the investment, or the currency play, if you want, is
Mhm.
always important. Also, the choice: do you go for having your exposure in the local currencies or what we
Mhm.
call hard currencies? Hard currencies still it's the US dollar, of course, but also people consider the euro as a hard currency. But
Mhm.
that's it's just sort of the definition in that sort of investment space. So circling back to the Asian currencies, it's as you mentioned, it's they of course currently moving a bit higher towards the US dollar. The US dollar is
Yes.
sort of weakening, so that's sort of two things of the same issue. But
Yes.
what do we think 3 and 6 months ahead? Do we have a clear view and also sort of where we say this is what we would choose to do
Mhm.
about the
Well,
currency?
it's looking like Asian currencies in general could outperform the dollar in the next 3 to 6 months. Mainly we see that because as it stands now, currencies are appreciating against the US dollar, and this trend will most likely hold as or even pick up faster once the Fed does unroll its series of rate cuts that which are still expected to come in the next 3 months to December. So any signs that the Fed will continue in its plan to cut its interest rates further will prop up Asian currencies in general as a whole. And regarding debt, current companies or we generally prefer seeing more local currency exposure. So that way, especially if you have investments in or a business in a certain jurisdiction, it's easier to manage your debt if you borrowed in the local currency, and that could also support the trend among Asian currencies. So once investments flow to these emerging markets, for example, and local currency exposures are better in a way, since you'll be able to manage it better if once we see that the appreciation of local currencies continue, right? So yeah, that's what I expect in the next couple of months.
Yeah, that's important. And
Mhm.
of course, I could ask you, yeah, but why should it happen? Isn't it so that the Asian central banks they would just follow the US central bank lower? So when the Fed is cutting rates, will the Asian central banks follow suit, or will they not cut as much?
Um, it's looking like Asian central banks are, yeah, they are cutting, but at the same time, not at the level or pace that the Fed is expected to. So, for example, the 50 basis point cut that's being expected by many market watchers from the Fed is unlikely to be matched by the same level or gravity by local policymakers. Some central banks actually started cutting ahead because they've seen inflation go down much faster or earlier. So, for example, the Philippines has already started cutting rates a few weeks ago. So, even before the Fed started its own. So, it's not as much of an expectation from most policymakers to suddenly or do a rate cut in one go. So everything's been likely to proceed more gradually relative to the Fed because big time. A 50 basis point cut is quite big time for smaller central banks. So yeah, that's what I think will happen.
Yeah, that certainly sort of supports the view that the ASEAN country currencies could outperform the US dollar for a period. And also to mention that here in our company, Lockbridge, when we do as a wealth advisory, we build portfolios for wealth clients. Of course, there can be all kind of individual sort of whatever conditions that we should take into account, but in general,
Yeah.
we currently we choose to have what we call the local currency exposure or the Southeast Asian debt or emerging market debt in general. So, and this is also basically following the view that you are representing, Mel. This is how we
Yeah.
advise our clients. So yeah, and that will be extremely interesting. And another topic, and that's sort of a major topic that we are bringing to the table today as well, is also taken from the markets, and that is actually sort of the a bit more difficult conditions in the stock markets. We saw in last
Right.
months in Euro region that the August starts up with a drop of 13% in the Japanese stock market. That was dramatic. But now
Right.
this September we see that sort of the negative impulse is actually generating sell-offs again, and that is in a region from New York, Wall Street, and that is companies that predominantly are sold out. Well, how should we sort of go around this? So we have argued also when we wrap up on our podcast and saying, okay, how do we see the global stock markets and also the other sort of parts of the financial markets, we have been okay so far. Should we be nervous now, or how are we seeing the stock markets? What do you think?
Right. So the US Fed as decision aside, what we saw the past few months or maybe past year is that tech stocks went on a really huge rally, and that lifted everybody, all indices in the past few months. And now that there's been some issues relating to some tech companies, so I've seen Nvidia, for example, maybe some jitters also over telegrams that the CEO's arrest, and maybe on the ban on China-made EVs, for example. That's been hounding tech stocks recently, and that's been one of the reasons behind the dive. But it's mostly a correction as well, because the higher you go, maybe there's a lot more for you to adjust moving forward. So, but in general, this decline in US stocks could be temporary and could even level out once the dust settles after the Fed does implement its first rate cut, and then the all eyes will be on the next Fed move, which some argue will be immediately after the September meeting. But otherwise, we don't really fear. We see this as a correction, and it will not tumble, like it will not go on a free fall. Rather, it's just a correction that the market needs to do. That's what I see, Peter.
Yeah, yeah. I very much agree that that's sort of the trend turn or correction right now is led by tech stocks, and now the whole stock market is paying the price for the extreme bullish component that we've seen within the tech
Right.
stock sector, so to say, the past 12 months, that lifted the whole stock market higher. So a lot of stocks went up in the past 12 months because the tech stocks went up, and that simply took the whole market up. And these as a stocks that sort of just came up without any reason, of course, risk to feel sort of a reset as well downwards. when the tech stocks dive,
Mm-hmm.
because it has been a very hot trade to be long tech stocks simply.
Mm-hmm.
And I just also agree and see that people are reducing these positions. So it's not so much a reaction on a global nervousness or outlook, but it might be a reminder that it's not so easy for the rest of the year when we look into
Mm-hmm.
particularly the stock market. This is as we are simply exploring more volatility.
Mm-hmm.
Things doesn't come automatically, just being long and then don't think and consider anymore. This is we need to be more observant. We need to be more precise in how we build and pick our positions
Mm-hmm.
and do the sort of be a bit more active, I believe, in the application and maybe some shifts now and then in a volatile market or market with increased volatility. And then we also need to prepare to the situation that the European stock market probably ends up around zero in return, or maybe
Mm-hmm.
for some negative. We are right now seeing Euronext 100 with up 5% for the year, and that can be erased within sort of a couple of days without any
Wow.
problem. Yeah, that happens.
Mm-hmm.
And the French stock market is around zero. Yeah, German stocks are still sort of up with sort of around 7%. But again, this is within sort of just 1 week of a negative trend. And then we have a European stock market that is back to square for the year. And this is, yeah,
Mm-hmm.
just underlying that it's not so easy to be an investor anymore. We will need
Yeah.
to consider well what we do. I think that is sort of yeah um, the, 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 the the main takeaway. Um, and if we should conclude on how we do see the global sort of financial markets, the outlook, um,
Mm-hmm.
again, how do we to start with the Asian region? How do we see it? Currently, we are long-term optimists, so to say, as our recommendation has always since long been overweight risk, so to say. Yeah. Um,
Yes. Asian stocks are going to more or less track the Wall Street, but in terms of of currencies, we see Asian currencies picking up further against the U.S. dollar, especially once the Fed cuts interest rates, and we see that local currencies could outperform the dollar in the coming next few months, and we still see some risks in the outlook for economies here in Asia, especially, for example, China is still has to contend with its property crisis issue, but we remain optimistic about these risks. We see these risks as opportunities to grow, and we continue to, yeah, we like our positions or we take positions in emerging markets in Asia.
Yeah, I would also say we've had the conversation now saying, okay, as a sort of volatility, maybe a bit nervousness is we reckon it's rising currently, um,
Mm-hmm.
but we still overall like to have risk and also more risk in the allocations, investment allocations than would be average or neutral or whatever, how people
Mm-hmm.
they express it. So we like an overweight into the stock market still. We like to have a longer duration in the bond portfolio than would be a neutral benchmark. We like the emerging markets, and as discussed today, we also like the local currency risk. So
Mm-hmm.
and then all in all, the total baskets represent a higher risk than a neutral position, and it also after all underline that we have faith in the world. It is a more difficult world, and the developed world is going towards more macroeconomic headwind.
Mm-hmm.
But there are a lot of opportunities out there. We also like alternative investments. So this is still our base scenario.
Mhm.
The current gyrations we see in the global markets is, we reckon they're there, but we are not scared and we are not running away so far. So
Right.
yeah, that was all for today. Mel, thank you for being here together with myself, and thank
Yes.
you to the audience to listen to us. And yeah, we are back next week again. We'll be monitoring global developments and will share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Lundgren's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgren's Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated mutual China fund. To know more, visit lundgrenscapital.com.